Right everyone, for all the Forex traders that are day trading using technical analysis, price action strategies, I know you're finding it very inconsistent with your trading, trying to get results because you don't fundamentally understand why the markets are moving. So you need a really good education in interest rates, okay? The fundamental reason the currency markets go up or down in value, let's take the pound against the US dollar, which exchange rate moves every single day. It's always based on who has the higher interest rate, because the performance of a country's currency is going to cause something called inflation, which you know about, and it's the inflation that causes interest rates to go up or down. Now, whoever has a higher interest rate, that currency is in demand because investors are always trying to put their money in the bond market where they can get highest rates of interest for the least amount of risk. Remember, government bonds are the safest investment in the world. And there's something called the overnight carry trade. Whenever you take a trade in a currency pair, you're either going to be getting free money into your trading account every night you hold that trade open by the broker, or they're going to be taking money out. So many people don't even know this. So I'll historically show you how this works throughout history, and I'm going to give you a spreadsheet that will show you where interest rates are going so you know where the markets are putting their money, okay? This is going to be so powerful once you understand what really drives the currency market. So enjoy the video, enjoy the spreadsheet, and I promise you, you'll never ever trade blind again. Right everyone, the overnight carry trade. I'm going to show you in this video a strategy which the hedge fund community have been using as of date, okay, with the Japanese yen. I'm going to teach you why the carry trade is the most powerful strategy used by professional traders and how you can incorporate this into your trading if you want to learn how fundamentally the Forex markets move when you're investing, okay? Because today, and the last few days, the Japanese yen got very, very strong over the last few weeks, as you can clearly see. And yesterday, it really was exacerbated because the Bank of Japan raised interest rates, okay? So you can see yen soars to the strongest since March as the BOJ, which is the Bank of Japan, reignites the rally, okay? The Bank of Japan raised interest rates yesterday for the second time this year, but they're signaling more interest rate hikes are coming. So why did the Japanese yen go so strong? Well, if you read the headline here, hedge funds post their biggest retreat on bearish yen bets, okay? Because look, the Japanese yen, up until the last week or so, as the markets were betting on this rate hike, the yen has got considerably weak, especially against the US dollar. We're seeing the yen since COVID lose 55% of its value, okay? So what caused the yen to lose so much of its value? It's all down to hedge funds were betting against the Japanese yen because of a carry trade. You see how it says hedge funds beat a hasty retreat on bets against the yen as the once beloved carry trade crumbles. So what is this carry trade? Okay, this headline says it here: yen rally gains steam with global carry trades in the balance. So again, what is a carry trade? What are they talking about? And you can clearly see down here, ultra low interest rates in Japan have made the yen a favored funding source in recent years for carry trades. The trade is being unwound as investors bet on more rate hikes in Japan. So what are these hedge fund strategy with carry trades? What is this, okay? Once you understand this, you will understand fundamentally why the Forex markets move. It's always down to interest rates because the carry trade is the number one strategy which hedge funds are using. And guys, who drives the currency market? The hedge funds. They're the ones with the biggest funds and the biggest amount of capital to move the market. So let's break down the carry trade. So the carry trade is, so this is the headline on Bloomberg. What is the carry trade? Okay. So for us to understand, the carry trade is when an investor borrows money in country A where interest rates are low, which is Japan. The Japanese central bank just raised interest rates, but they're still close to 0%. So they borrow money in Japan where interest rates are low, so they can borrow money cheaply, and they exchange the yen for the currency of country B, like the United States, where interest rates are high, okay? And then they can earn a profit on that trade every day they hold the trade open, or they can go and buy government bonds in the United States and then earn free interest. This is basically the carry trade. So let me break it down and explain it. In the United States in 2022, after COVID, as you guys know, inflation was out of control. So look, we had inflation in the United States at March 2020 at 8%. way above the central bank's 2% target. This is like one of the macro spreadsheets that I use to analyze the United States when we fundamentally use macroeconomics to trade the currency markets professionally, right? So inflation was very high. So what did the Fed do? They had to raise interest rates to try to get inflation back down to 2%, right? And we can see the first rate hike happened in March 2022 over here. The Fed raised interest rates for the first time in March, right? So as the Federal Reserve is raising interest rates in the United States, well, if you understand what government bonds are, government bonds is when you borrow money to the US government. This is a 10-year government bond over a period of 10 years, and you get free interest on that investment. Then the government gives you back your money. The 10-year government bond is the most liquid asset in the world, the safest security you can buy. Because you borrow money to the government, they're not going to go bankrupt, and you're going to get your money back. So over here, when they say you borrow money in country A and invest it in country B, where interest rates are higher, and then you invest it in bonds, this is one part of the strategy. So let me show you how this played out. So look, the Fed started raising interest rates and then went all the way up to 5.5%, where they are currently. So interest rates in the US went up aggressively to try to fight off inflation. And look at the interest rate on the 10-year government bond in March 2022. It was paying 1.68%, as you can see on the right-hand side. But look at the USD JPY exchange rate. Remember what the strategy is. You borrow money in Japan, you sell the Japanese yen to buy the US dollar, and then you buy US government bonds and you get free interest, right? So look, as the interest rate in the United States is going up in 2022. So as the interest rate continues to climb in the United States, as we can see on the right-hand side, look at the left-hand side. Can you see the exchange rate goes up in the dollar's favor as the government bond in the United States is paying a higher amount of interest? Soon as the interest rate on the government bond in the United States goes down from 3.2 to now 2.8, look at dollar yen, it goes down at exactly the same time. As soon as the exchange rate takes off again and goes up, what happens? Dollar yen goes up. As soon as the interest rate on government bonds starts to come down, dollar yen comes down. As soon as the interest rates start to go up again, dollar yen goes up. And then when the interest rate on government bonds in the United States have a period here where they start to decline, what happens? Dollar yen declines. And then as soon as the interest rate starts to take off from here, during this period over here, government bonds in the United States go from 3.3% to 5% interest rate. What happens at exactly the same time? USD JPY starts to go up at exactly the same time. And as soon as the bond market comes down, USGY comes down. And then look, as soon as the bond market takes off again, no surprise, dollar yen takes off again. And then when the dollar yen exchange rate is declining, it's because the bond market is declining. So you can see a perfect correlation between the two. So to understand this correlation, you just have to understand what this strategy basically is. Investors around the world, they want to buy government bonds in the United States. But if they borrow money in Japan and sell the yen in exchange to buy dollars, they can then basically use the yen as a free currency to invest into the United States and then get that interest rate paid on government bonds of now, let's say 5%. Okay. Now think of all the pension funds around the world that are not really allowed to gamble their money in the stock market. They're not really allowed to gamble in crypto and gold. What they do is they need to buy government bonds, safe securities that pay out a specific amount of interest. This is why the carry trade really moves when you're seeing one country raise their interest rates, especially in a country that the markets perceive as very safe to invest your money. Government bonds in the United States are the safest investment you can make, right? On the other hand, what you need to understand about the carry trade is when you're selling one currency in exchange to buy another currency, people don't really understand that you're actually getting money credited into your trading account or money debited out of your trading account based on which way the trade you're taking, okay? So let me show you. When you're taking this exchange rate trade for the dollar against the Japanese yen, if interest rates in the United States are at 5.5% and interest rates in Japan at the time when the Fed started to raise rates are at minus 0.1, when if I sell the yen in exchange to buy the dollar, I pay no interest on the yen that I borrow. And when I sell it in exchange to buy dollars, I get paid 5.5% interest on the dollars that I purchase over 365 days. So the carry trade when investors are speculating is that if you sell the yen to buy the dollar, if you're a hedge fund with 1,000 lots that you're trading, okay, I know a lot of you may trade 1 lot, 2 lot positions, but if you're trading 1,000 lots, which big billion-dollar funds will be doing, look how much free interest that works out on. You're making $162,000 a day in free interest. For you guys who may be taking a 2-lot position, for an example, you may be making $32 free interest, but every day you're earning free money because of the interest rate difference. On the flip side, now if I take that trade in the opposite direction, well, then it doesn't become very profitable, okay? 1 second, sorry guys. So let's go back to the hedge fund position. Right, if I take the position in the opposite direction and I sell the dollar to buy the yen, I don't want to take that trade. I'm now losing $160,000 a day. Every day you hold that trade open. Because remember, when you borrow, the interest rate set in a country's central bank, okay, sets the interest when you borrow money either from a bank in Japan or in the currency markets when you're using your retail broker, or when hedge funds are using the prime brokers like Goldman Sachs or JP Morgan. The carry trade is active. So what you need to understand is when this interest rate in the United States was at 0.25% in March, which I showed you over here, when that interest rate starts to go up every single month that the central bank is raising interest rates, look how much the carry trade becomes more and more profitable for investors. So look, if I sell the yen and buy the dollar, it starts off with, if I'm taking that position in lots, 1,000 lots, it starts off by paying me 10 grand a day. But look, as each interest rate increase goes up by the Federal Reserve, I'm making now $17,000 a day. Then the Fed started to go up in 75 basis points. They started to raise rates really aggressively, 0.75%. So when rates start to go to 1.25%, now look how much you're making, 40 grand a day. And then they went up again to 2%. Now you're making 60 grand a day. And then you're going up to 3%, 90 grand, 4%. You're making $120,000 a day. Remember, some of these funds may be trading more than the lot size I've just put in this as an example. But the higher the Fed goes, the more money hedge funds are making. So hedge funds in the around the world have been using the carry trade to bet against the yen, because the yen's a low interest rate paying currency. So as they're earning this free 160 grand a day, and then they see the currency go in their favor by 50%, 40%, that's huge returns on $1 billion fund. Think of how much money that is. Okay, so as the carry trade takes off, there's 2 ways investors make money. They can go and borrow money in Japan and then sell in exchange to buy dollars and fund purchases of government bonds and earn a nice 4% interest. Or they can just be speculative traders and go in the carry trade, sell the yen, buy the dollar, and earn that free 160 grand a day, and then make money on the appreciation in the exchange rate of 40%. Right? Makes sense? But for investors to hold the trade, they need interest rates to remain high in the dollar's favor. So the reason why you're seeing these headlines talking about hedge funds unwinding the beloved carry trade is because now, yesterday, the Bank of Japan raised interest rates. Okay? So interest rates in Japan have now gone to 0.25. So look, your free interest has now gone down to 150. From currently paying 160, right? And yesterday, the Federal Reserve just signaled to the markets, if you go to Bloomberg, yesterday, the Federal Reserve just signaled to the markets that they're going to start cutting interest rates. That's what the Federal Reserve said. Look, Fed on course for September rate cut. So what would that mean? Right now, the markets are predicting rate cuts in the United States. So this spreadsheet here is where we understand where the markets are predicting interest rate cuts. Because for you to understand where the bond market interest rate is going, you need to know where the markets are predicting interest rates to go. Because remember, the interest rate on government bonds is going up as the Federal Reserve is raising the overnight interest rate, okay? So government bonds pay more interest over the central bank's interest rate because investors want more money because they're unsure of the risk of inflation, right? So remember what I just showed you, as interest rates are going up, government bond interest rates are going up, okay? But when you have periods over here where the bond market is going down, all right, or even where we are right now where the exchange rate is falling aggressively as the bond market interest rate is going down, it's because now markets are pricing in interest rate cuts. So think about it. If you're an investor that bought a government bond and you're getting paid, let's say you bought it over here and it's paying you 5% interest, perfect, you're happy to hold that trade, right? But look, you can only make that 5% interest if the currency doesn't go down in value by more than you're earning interest. Because if you're making 5% interest, but the currency pair then drops by 8%, well then the interest you've made in the dollars that you bought for government bonds, the interest you're going to get paid in dollars. When you sell it in exchange back into yen, when you close the trade, you've lost money because the exchange rate's gone against you. So the only way the carry trade works is if exchange rates are stable. But the moment investors realize, and it's all being driven by the carry trade, once investors over here are betting the Fed by, look, this spreadsheet is how you anticipate whether the Fed is going to raise interest rates or cut interest rates at each meeting going into next year. So look, we can see we're expecting a rate cut in September, November, January, February next year, May, July, October next year. So the interest rate in the United States is going to go down to 3.75%. 3.75%. So if a trade is now earning 150 grand a day, 3.75, it's going to go down to 100 grand a day. However, the Bank of Japan is also expected to raise interest rates. When we scroll down here, we can see the markets are implying by next year, December, rates in Japan are going to go up to 0.5%. So let's take a look at where the carry trade is going to be in a year. Only now paying 90 grand. So do you see why the carry trade is unwinding so rapidly? Because if you was an investor who was holding the trade from down here and you was locking in 40% profit, but now you realize that the carry trade is going against you where you're not making as much money every day, right? And the bond market investors are also understanding that the traders who had already locked in maybe 40% profit, they don't want to now only take home 30%. And if the exchange rate keeps falling, they may only take home 19%. So everyone who's been locking in all these profits from the exchange rate going up in value, earning the free overnight carry trade in the currency markets from the broker paying them, okay, or the investment bank, as I've just shown you over here, this free money getting into their trading account, or the investor who's been buying government bonds, they now realize I need to cash in my fucking chips quickly before I fucking lose my money that I've been making, because the interest you're getting here, if the exchange rate drops by more, you've lost money. If you're the investor in the carry trade and you've made a huge profit on your trade of 40%, it's now go down to 30%. You want to get out quickly before it goes down to 14%, because it can easily go down by another 10% if everyone cashes in their trade. So the yen against the dollar goes up in favor of the dollar when the carry trade is paying investors free interest overnight plus a capital appreciation in the trade, and it makes the bond market very attractive for investors. That's when the carry trade's working in favor. But the moment the markets are predicting the carry trade to unwind, now you see the beloved carry trade crumbles. Okay, now you start to see the carry, that trade is now being unwound as investors bet on more hikes in Japan and the chance of further interventions by authorities. You see, now you understand what fundamentally drives the markets. So for you as a currency trader to understand when to get into trades, number one, you need to understand what are the markets predicting for interest rates. Because when you have an idea of where interest rates are going to go, meeting by central banks, you can start to then predict, is that interest rate difference getting in favor of one country or out of favor of another country? So an example, you can see right now the interest rate in the US and Japan is currently in favor of the US by 5.25%, but in a year's time, it's going to go down to 3%. So you already know if it's narrowing and no longer being as favorable for the dollar, you know investors are going to cash in their chips. So dollar yen's going to be going down. If for an example, the interest rate was expected to go to here, which is never going to happen at 7%, but the interest rate difference is going to go even more in favor of the dollar, well, you already know what investors are going to do. They're going to sell the yen by the dollar. So this spreadsheet gives you the idea in your mind for you to be able to see, okay, where are central banks taking interest rates? And then where are other central banks taking interest rates? Let me compare the two so I know where the hedge funds are putting their money, because they're only putting money in the currency market speculatively when they know that the free interest they can earn overnight is getting bigger and bigger and bigger. And that is where they chase the carry trade, because they're making more money every day they hold that trade open, which causes more investors to come into the same trade, which causes a big appreciation in the exchange rate. That is where you get massive moves in the currency markets. So what you need, guys, is what I'm going to provide you with. You need this spreadsheet here to calculate how much do I earn if I take the trade overnight, okay, free interest, so you can understand Are hedge funds making money if they sell an exchange rate or buy an exchange rate? Which way they're making money? And then is that difference in interest rates going to go in favor of one current country, or is it going to narrow if the other country is going to raise interest rates? Which way is the difference in interest rates going? Because once you understand the difference, you know where to place your trades. So when we look over here, guys, I have this channel over here for you where every day you're going to get updates where the central bank's interest rate is going, meeting by meeting over a 1 year period. So you can already forecast, okay, we know where the Bank of England interest rate is going. We know where the European Central Bank interest rate is going. We know where the Reserve Bank interest rate is going. And then you're going to get this spreadsheet download here for you to be able to calculate the difference. Okay, right? So every day you're going to get these updates. If you don't have this data, and I've shown you where the bond market moves, for you to understand where the bond market is going, and for you to understand what the overnight carry trade is going to be paying, you have to have this data. Otherwise, you have no idea where the markets are moving. You have to have this. So this is what I'm going to provide you. And I'm going to provide you education for access to the education channel. I've got 500 members in here. I update them on the spreadsheets and the interest rates. And then I give detailed breakdowns, videos explaining what's happening in the markets. And this will really help you understand. Look, I did a whole video on USD JPY. Look, I did this on the 24th of July. I then sent the trade yesterday to the members. Look, we're selling Euro JPY, selling USD JPY. I got 500 members. They can follow my trades as well. You can upgrade to the Signals channel if you want. Look at the results. I just want to show you quickly. Ryan, yesterday made £1,000 profit following my trades. Okay. Zabar yesterday made £700 profit following my trades. Jamie made £500 profit following my trades. Chris made around £500. Samuel made $2,800 profit. Taylor made himself $7,000 yesterday following my trades. So you can understand what's going on and you can follow trades. Guys, trust me when I tell you now, this is fucking powerful. When you understand what really fundamentally drives the currency markets, it's powerful. Okay, so all you need is a daily updates. If you want to get your hands on this actual spreadsheet here, which I've been showing you, where you can get the implied rates yourself and you can update it, but that's part of my advanced Forex fundamentals course. You want to learn macroeconomics, you want to understand how to break down an economy and understand where the economy is moving with inflation, interest rates, central banks, you need this education. But first of all, just come over to the channels, get your access, okay? Click the link below this video. It's going to give you monthly access into these channels. You're going to get the updates. You're going to get the spreadsheet downloads. And if you ever want to reach out and come into the Signals channel, you can just message my team and I'll be happy to trade alongside you. Guys, you just learned the #1 strategy for hedge funds. The #1 strategy. That's fucking powerful, man. And I really hope it does transform your trading. So I hope you guys enjoyed this video. Please like, comment, subscribe. Tell me if this video has helped you. And I hope it has. And honestly, guys, I want you guys to understand what really drives markets. When I first started trading, I was using technical analysis, day trading strategies. So it doesn't fucking work. And I know if you're trying to do that strategy, it doesn't work because you don't understand why the markets move. The professionals like hedge funds are using this strategy. Macroeconomics, fundamentals, carry trades, it's all fundamentally driven by something. And it's interest rates. So you need to learn that for yourself. All right, guys, enjoy the video and I'll see you in the channels. Okay, cool.